I can't come up with a conclusion that in the next few years, platinum's going to go berserk more than gold. No, I can't do that. It may, has its own unique fundamentals. The one I do think will go berserk relative to gold is silver. Okay, we know it's vastly undervalued to gold in terms of spread relationships, and we plot these in our reports and update them. We also know that gold and silver miners are vastly underpriced in relation to the ounce of gold and in relation to the S&P 500, for example. So as a category, both silver to gold looks cheap and ripe to go up many more multiples than gold will.
This is Little by Little with Andy Schechtman.
All right, everybody, welcome back to another episode of Little by Little. I am thrilled to have Michael Oliver with me, the founder and CEO of the Momentum Structural Analysis newsletter, someone I've been following personally since 2019, gives a fresh perspective on things that you don't find everywhere else, and certainly someone who I think all of you should be following, as do I, if you want to have a very well-rounded view of the markets, not just precious metals, but all of the markets. And Michael, thanks for jumping on in. I appreciate it. It's good to see you. And how you doing today?
Doing fine, Andy.
Wonderful. Well, thank you for coming on. Let's jump right into it. Can you explain for my listeners the core principles behind momentum structural analysis and how it differs from traditional technical or fundamental analysis? Why do people need to be following your work, I guess, is what I'm getting at.
Fundamentals are meaningful, but they're and also a lot of technicals that people use, quote technical, including the word momentum, are what we term wet noodle indicators. And in fact, they look like wet noodles when you look at them on your screen, and usually they're free with your quote system or whatever, they should be. Pardon me. 30 plus years ago, I caught the crash in 87. At that time, I was a futures broker with E.F. Hutton. Okay. I'd started with Hutton in 75 when gold got legalized. And my boss was also the head of the Hutton's department, major commodity division, and the COMEX at the time. Exciting times, 70s through the 80s. Bunker Hunt years, remember? Okay. He was a routine orthodox technician, and he sat me down and showed me how to draw charts, And so I learned that. But in 87, I started applying some rough rules that I developed on momentum, meaning I plot, instead of plotting just a high and low and a closed bar chart, like everyone does, daily, weekly, or monthly, let's talk monthly now, and measure it in relation to a 3-quarter moving average, for example. It's fairly long-term average. It's sort of like a 200-day, in terms of duration. So it's fairly long-term. And it's not an issue of crossing above or below the average. That's meaningless quite all. But it's when you plot that oscillator, where is this month's range in relation to that particular moving average? Is it above it, below it? You plot it on an oscillator. You end up with quite often, a totally different picture than you end up when you look at a price chart. And usually at major tops and bottoms and intermediate tops and bottoms, momentum will tend to lead first in the new direction. And so I find it exceptionally reliable. But we don't just look for the thing to loop up or loop down. We want to see structure broken. So not just the word momentum, but structure. What's structure? Same thing that price chartists look for. There's a trend line. Bang, bang, bang. You hit it 3 times or so. You draw your line. Uptrend, flat line, whatever. We look for the same things on momentum. And quite often we'll see them on momentum, but you won't see them on price. So for instance, right now, looking at the stock market, you see this upward pattern of almost an upward arc, okay, in the U.S. stock market bubble. But when we run our quarterly momentum, we see a floor. We see a flat floor. And it says, boy, you better not break that floor. And we're waiting on the NASDAQ to do so, because the NASDAQ 100 is a leader index. Anyway, that, in shortest I can define it, is the basics of our method. There's a lot of little additions we've made to it over the years, but basically it's not changed all that much in 30 years.
I've been doing this for 35 years this next month. I've followed a lot of people over the time that I've been doing this. People that have employed various techniques. Guys like Richard Russell, my mentor. Other folks like that would talk about Elliott wave and Kondratiev wave. Other folks that were just strictly technical. Other folks that were big picture macro and didn't apply any technical analysis. Would you say that the momentum analysis is kind of a combination of human psychology, wave theory, and I may be way off on this. It just seems to me that it seems to have a certain amount of human emotion built into or in addition to technical analysis. Is that even remotely in the right ballpark?
Yeah, sort of, because when a market runs out of momentum, and I don't mean by certain wet noodle indicators, but when we could see it on a chart where the market, let's say for a 6-month period of an old bull market is making a new high and momentum saying, I'm not making a new high. And I'm toying with this big structure. That indicates that really underneath the surface, even though price still looks like it's beating its chest, it's really not. So to some extent, that could reflect emotion.
And is this your proprietary?
Yeah. It's,
because I haven't seen it anywhere else.
I think one of the major on-screen technical services tried to use the phrase, we didn't sue them, I didn't even know about it until recently, use the term momentum structure. And then they retracted it later. And it's not because we knew about it and told them not to do it. It wasn't anything like that at all. But that's the difference that we use in momentum. Most of the momentum indicators, the wet noodle ones, they tend to be too focused on the near term. There's also a lot of technicians tend to have behavior. They see certain behaviors over a period of time. Like, let's say this wet noodle indicator will get up to this level and then relapse, and then get back up to that level and then relapse. And so when it gets up to that same level that they consider, quote, overbought, there's a lot of them right now saying that about gold, for example. Yeah, by certain standards of the past year or 2 or 3, maybe it is, quote, overbought. But in a market, markets change and their dynamics change as the fundamentals change underneath the surface as well. Sometimes not obvious to everybody looking at the charts. But the notions of what's overbought or oversold can change. You can push into a new level of overbought that you've not seen in years. In fact, if you go back and look at major bulls or bear markets, bull markets in gold and silver, you'll see in that last year of a bull run, they go off the page. Not just in terms of price, but in terms of dynamics that people think are norms. The norms get shattered. And that's when people miss out on something big. You know, they've been patient, maybe. A lot of people aren't patient in this market. You know that. They're very impatient. But you've got to have that broader context. And you're right. Emotion does play. It always does in all markets to some extent. And usually, as a market's about to lift off and go ballistic, emotion will enter at that point, and it's justified. It's fundamentally justified. Now, late in a bull trend, after it's bleeding obvious why the market made the move anyway, and then suddenly people want to join in, then maybe the emotion's bad. So it's not always the case that, the notion there are too many bulls out there. Well, sometimes, for instance, back in the dot-com bubble, we followed the stock market tops pristinely. We've archived them even. But at the dot-com top, I remember in 1999, a year before the top, I was in a grocery store, and there was I think it was Money Magazine or some popular financial type magazine that the public would buy. And it had a young couple on the cover looking up into the heavens saying, it's not too late to you too can get rich on internet, okay? And you know what? It was valid. If you bought that magazine, was in March of 1999. For the next 9 months, you would have made a ton of money. So it's not always the case that emotion is bad. Sometimes, in fact, it's right. The question is when the technicals say, got a lot of emotion here, but momentum says you're not what you look like. And right now it says for us in gold, this thing hasn't even begun. to go berserk.
Well, that's music to my ears, and we'll get to gold in a moment. You said something that kind of piqued my interest. You said a lot of analysis is too short term. How do you differentiate between the short-term momentum shifts and the long-term structural changes in the market? I'm a macro guy. I like the long-term structural changes. How do you do that?
Well, we emphasize to our subscribers, particularly as regards gold, like we got bullish on gold 3 months after its bear low in 2015. February 2016, at a price of $11.40, we said, that's it. Bear is over, bull trend commences. And it's been a layered process, obviously. You know, you've had hundreds of dollar drops on the way up, and yet it still persists. The short term sometimes comes into play if you're concerned, for instance, with something that's very time sensitive. Let's say you've got call options and they're going to expire in 2 months, okay? And you've made some money on them, but you got to be careful here. And the big stuff says, no, this is still going to go on for, a good while. We're not threatening the bull trend, but you could have a wobble, the kind of wobble that could kick you in the gut in terms of your call options, or perhaps a levered future position, et cetera. So sometimes short term or intermediate term is somewhat important, and we do cover that when we think it might be important. But we don't want to confuse our subscribers, many of whom are institutional, by the way, about confusing a short-term or intermediate-term negative with the full context that may be bullish. Because if you're a genuine investor, and there are very few of them around anymore, I think there was a study recently my son told me about that said that a major brokerage firm said that the average holding period for an investor is a month. What a world. But anyway, we need to differentiate between what's short and intermediate and long term. Don't confuse the two. Otherwise, you'll miss the big moves.
It sure is. What a world. And I just saw that last Tuesday, just as a coincidence, last Tuesday was a record trading day in U.S. stocks with prices less than $1. And you normally would associate that with speculative mania.
Yeah, it's interesting.
At the same time, it was the highest percentage of volume that we've ever seen on the NASDAQ in one day, 13.4 billion shares. Crazy time, man. And what do the Chinese say? May you live in interesting times. That's a curse, by the way. So sticking with precious metals, Michael, and that's what really got me interested in you. I remember going on long walks during the pandemic, bundled up in Minnesota, where I used to live for 50 years, and walking and listening to you explain your take on the gold and silver markets, which I will say were really eye-opening to me, because it was a way of listening to things or learning about things that I hadn't been exposed to in your momentum analysis. And thank you for that. I know that it has been a major focus of your work, simply because I've been following you since 2019. With that being said, what do you see as the future for the precious metals market? At least, well, we can go out as far as you'd like. In the context of the current global economic climate, the macro picture.
Since the Fed was founded over 100 years ago, we've undergone boom-bust cycles in the stock market. And you've undergone, if you'll look at the data from the Fed, like Fed funds rate chart, go back 50, 60 years, or M2 growth, We've been through boom-bust cycles on the monetary side, which has helped fuel many asset categories from time to time. Much of the time, especially if the stock market's been beaten up after the bust of a prior bubble, it'll turn up again when they re-stimulate the economy. And with lower than reality interest rates, for example. Well, we've certainly undergone that since 2009. About 10 of the last 15 years, we've had free rates, Fed funds. And money growth has been more than it is in any other 10 or 15 year period. It's also, M2 is growing. So you have a degradation of the money, but investors ultimately are the ones who allocate that river flow of liquidity. And back in 2009, it was justified technically. In fact, we said so. We said this is a major low. The Fed was pumping money, and at that point, it worked. In other words, 2007, they started pumping and cutting rates at the top. 1 month before the top, they started cutting rates sharply, and it didn't help. The market collapsed, 50% drop in the S&P. They did similar stuff 2000 to 2002, yet NASDAQ 100 dropped 82%. So there's times when they create the money flow, it doesn't help the thing they want to help. And right now, I think we're in a super bubble situation. In several major stock indices, US, Japan, India. Those three, the Sensex, the Nikkei, and the S&P, and the NASDAQ 100 especially, compared to the Shanghai Composite, for example, which is not a bubble. It had a bubble period, but it broke. It's not even, I think it's trading about double where it was in 2009. Well, S&P is trading about 8 times higher than 2009. NASDAQ 100 about 18 times higher than 2009. And plus the bull trends weren't like 4 or 5 years, which they normally are, 23 to 29, 94 to 2000, 6 years, 2009 low, but that's 15 years. There's a time difference and a multiple difference. And when you look at an M2 chart and you look at a Fed funds rate chart, you see why. Highly abnormal monetary policy. When that bubble breaks, and it will have its own reality way above and beyond the power of the Fed. It's always been the case at major tops. Whether the Fed cuts rates or not, it doesn't matter. When that bubble breaks, it breaks. The problem is this bubble has so many embedded errors in it. And now we know that the debt error included in this is not just home mortgages like in 2007, 8, and 9. It's government debt, U.S. government debt in particular. It's off the page disaster waiting to happen. Central banks, not just us, but other central banks, Japan, Europe, etc., are a club, and they'll move together. They may deviate a little bit here and there, but they'll move as a group. And they will act aggressively to try to defend the breaking of these bubbles. That money flow will go somewhere, and we're betting it will go where it normally does. Gold. You go back, 1930s, for example, when the stock market imploded, home stake mining, you couldn't buy gold. Home stake mining went up 1,000%. Okay. And it's similar 2000, 2002, 7 through 9, et cetera. So it's different this time. It's bigger than any prior gold bull dynamics.
You were mentioning a couple of things regarding rates and how people will turn to gold, and how rates are getting away. And I guess the two things that come to mind, you mentioned 2008 and 9. The Fed's balance sheet back then was $800 billion, a far cry from where we are right now. At one point, it was $9 trillion not too long ago, and I think they've whittled it down to under 8. But the point of it is yes, I mean, I get your point with how things have deviated from that point because of the Fed's participation in the market. And at the same point, mirroring what you were just said, Gregory Mannarino came out with something today. He says world bond yields, which have all been dramatically risen or have been rising dramatically over the past few weeks, are now suddenly, and just by coincidence, of course, all dropping. The 10-year Treasury, the German 10-year, the Italy 10-year, the Spain 10-year, and the UK 10-year are all down at the same time. And he's basically saying this was a coordinated effort to intervene because the debt market is running into that problem. Mario and I were talking last night about the 30-year Treasury in the UK now higher than when they ran into problems with the pension programs at about 5.6, 5.7%. What you are talking about, I think, is happening certainly in real time. And I think you're right. That would be certainly something to make people think a lot more seriously about gold when these things start to unravel and unwind. I couldn't agree with you more. And with that being said, with the relative undervaluation to gold in terms of other assets, which I'll mention in a second, with this massive undervaluation, do you think that the momentum behind commodities like silver or platinum, and that's what I mean about those two assets being, in terms of historically and geologically, undervalued in relation to gold. Do you think that the momentum for silver or platinum could surpass that of gold in this next cycle due to that undervaluation and that suppression of those two markets in particular?
Our view of platinum is we use the term precious metal, palladium as well. We use the term monetary metal for silver and gold. Okay. And there's a reason for the differentiation, which I'm sure you understand. Platinum, if you'll study it, we also are looking at the Bloomberg Commodity Index, for example, as an asset class. And it has been moving inversely to the stock market for some years now. And it's done that before the other way, on the upside. During periods of time like from 2000 to 2009 to 2013, in fact, the S&P was in a range. It made a high in the mid-1500s in 2000, came back to the mid-1500s in 2008, 2007. And it wasn't until 2013 it finally got out of that nominal range. So you finally began making money again. During that time, commodities were going up, okay? And even during periods where we have a so-called recession, like in the late 70s, the stagflation, remember that? Commodities were going berserk on the upside, so don't mix too many false notions in there. Right now, the Bloomberg looks poised to follow gold. It has not followed gold. During the period from 2015 to 2020, Bloomberg went down. Not a lot. It had already collapsed, but it continued to edge down while gold doubled. So there wasn't a good linkage. But right now, the technicals look like in this phase of the gold advance and the silver advance, expect broad commodity complex to join in. And it's an asset category that has both low risk and high reward, and stocks related thereto. Uranium producing stocks, copper producing, agricultural related, fertilizer companies, etc. They don't correlate well to the stock market. They do correlate well to the Bloomberg. Platinum is almost an overlay of the Bloomberg. It is behaving not like gold. It has been behaving for quite a few years now like the Bloomberg Commodity Index. So I can't come up with the conclusion that in the next few years, platinum's going to go berserk more than gold. No, I can't do that. It may, has its own unique fundamentals. The one I do think will go berserk relative to gold is silver. Okay, we know it's vastly undervalued to gold in terms of spread relationships, and we plot these in our reports and update them. We also know that gold and silver miners are vastly underpriced in relation to the ounce of gold and in relation to the S&P 500, for example. So as a category, both silver to gold looks cheap and ripe to go up many more multiples than gold will. By the way, this happened in the late 70s, 79 to 80, in the tail end of that bull market. Gold went up dramatically. Silver went up like fivefold compared to gold, okay? And it did it in the final year of that bull market. So it's not unusual. Similarly, it happened in 2010, in the final year or so, that 2010-11 peak, where gold peaked at 11, late in October 2011. Silver peaked in March of 2011, but silver went more berserk in the final several quarters of that move than did gold. It was like a white knuckle flight. I think we're going to have the same thing now with silver compared to gold. Gold is the mama, but silver's the wild dog on a leash. Okay, you know what I'm talking about. Okay, and that dog sometimes will run behind, as it did recently in the recent drop, and then there'll be times when it runs ahead. And I think we're about at that phase now where in the next leg up that we're about to commence in our assessment, because we've been in this, gold's been in a triangular congestion zone for now 3 or 4 months, okay? 2,800 high, 2,540 low, and twisting back and forth. Silver's had an erosional pullback from 35 into 29s. Now it's above 31 again. This next upsurge that we're about to see, and I'm talking now short to intermediate term, this next upsurge is likely to ignite that phase of the bull market where silver then dramatically outpaces gold. And probably also, if you wobble the stock market, you crack that bubble just enough to cause some fear and nervousness. Not a lot. You don't have to crash it or anything. You'll get some you'll get asset movement out of that category. And our bet is one of the places it's going to go is in the tiny little gold and silver mining sector. to where it will tend to go on a percent basis berserk. So that's where I think we are right now, literally, as we're talking. We're in that, near that phase.
And you cover the mining shares within your Momentum Structural newsletter, correct? Okay, good. Because most of the people that own physical metal that I've been talking to for 3 decades all have a little bit of exposure, some more than others, to the mining shares. So that's good to know. I'm going to ask you a question that's kind of near and dear to what I've been covering for the last 3-4 years, and that is using momentum analysis to forecast shifts in global power dynamics. And how do you interpret the momentum shifts between East and West the economies, particularly in light of the BRICS and the de-dollarization? Is that something that you're able to use momentum analysis with?
The movement of the so-called dollar index is a waste of time if you're a gold investor. For example, if you go back to the December 2015, gold was $1,050. Okay, it's well more than doubled. Okay, dollar index then was trading around 97. Right now it's trading about 109, so it's gone up 9 or 10%. Okay, if you looked at the dollar index, you said, well, gee, I don't want to buy gold because it's going to go up 10% next 11 years. Okay, well, it did. Gold doubled and then some. Okay, so it didn't correlate well. Sometimes it correlates a little bit here and there. You might see it. But the main thing that's driving the dollar index right now is the relative rates, especially at the long end. Our rates being a little chokingly higher than certain other rates. Okay, now that could change dramatically, and we think it could, like the rally we may be seeing right now in the bonds, the longer end of the market, the end that the Fed doesn't control, could in part be initial movement of assets out of the stock market by certain asset managers who are becoming doubtful of the stock market, looking for a better or a safer place to be, at least temporarily. And if you go back and look at history from 2000, 2002, big bear market stocks, 2007 to 9, big bear market. During those periods, T-bonds and gold went up, okay? So they are alternatives. The difference this time is that T-bonds are in a major long-term annual momentum downtrend in price, upward in yield. We think there could be a temporary counter-trend move in T-bonds, meaning you do get a drop in rates. Maybe we're starting to see it right now. That's not because there's virtue in the T-bonds. It's because there's a perception of risk in the stock market. The money is seeking other places to be. Some asset managers will naturally go to T-bonds, knee-jerk. The one that's really beating the stock market is gold. Nobody knows that hardly, but year to year, last year, gold beat stock market. You go back to the about 2015 or early, again in the 2020s, gold is higher on a relative basis than the stock market. So it's actually gained ground, not a perceptible amount, you can't beat the table over it, but it's actually been a better place to be. And yet nobody's pounding the table over it.
I do.
Yeah, I know, but that's great. I don't want anybody to pound the table over it.
Right.
They can come in later, you know?
Right. Well, it's funny too, in a world where information is so readily available. You're spot on. S&P 500 since 2000, 9.6% with dividends reinvested. Gold 9.9%, an asset that pays no interest. It's doubled the performance of the 10-year Treasury. It's up 28% this year, but that's not fast enough for people nowadays. Instant gratification, I think, needs to be immediately, and that's probably not even fast enough. And I'm sure you remember Richard Russell, and Richard used to say if you made 7% per year, you were a rock star. And here gold is outperforming that, and it's not fast enough. So it's interesting how the dynamics have changed.
I think those dynamics that people, trading short term and wanting money now is an indication of an underlying fear of uncertainty, a fear. I got to have it now. Can I have it now? There's no calmness out there. Even on the upside, it's not calm. It's not confidence. It's fear that's causing the buying. And sooner or later, it'll cause selling too. But I think there is an underlying fear. And then you talk about the geopolitical. From a technical perspective, the most vulnerable economies out there is not China, but it happens to be the U.S. primarily, even more so than Europe in terms of the bubble nature of its stock market. And of course, we all know that when the bubbles break, that's when the data points follow. They don't lead the stock market down. The data points always follow the top. So that the Fed likes to talk about, well, the job market's looking good, so we can stay tough on that. They know better than that. But once that stock market drops, 5-10% off the high, you can bet the monthly data is going to start to go negative, dark and quick. That's when
they say fear is the strongest motivator in the world. So I would agree with that.
Yeah.
Speaking of shifts in global power, I mean, is this a tool to even speak to the decline of a dominant superpower or the rise of a new one? Are you looking at that? You're not. You're looking at it in the way of bond yields and the dollar index, or are there other tools that you would use to say, yes, what is happening in this shift eastward is real, and what is happening in what's happening here in the West, the possible declining standard of living or our position on the world stage? Does momentum analysis help at all in that?
I think it provides you with some focus as to where to look the most for the most danger, most risk, most exposure of wounds, okay, that have been built up over 15 years plus more and many decades of this boom-bust cycle. But you asked me sort of a fundamental question, and we don't do that in our reports, but my background before I ever started MSA, which was in 1992, back when I was working on a PhD at University of Hawaii in political philosophy. This would be 1973, 74. I quit. I stopped in the middle because we were headed for global stagflation. A friend of mine had joined Merrill Lynch in the commodity division, said, come on in, the water's fine. Okay. I knew I wasn't going to get hired as a professor because at that time I was a radical libertarian, and I still am. I wrote a book on the issue of, pardon me for mentioning this, but you raised the issue. And so I see the world from this point of view.
No, I'm glad you did. Please.
I frankly think that we are, I gave a main talk at the Mises Institute back in March. They're the leading think tank for libertarian thought. I talk about my friendship with Murray Rothbard back in those days. I knew him personally, and I was writing my thesis at that time titled Anarcho-Capitalism. This would be in a master's degree program in 71, 72. And he said, this would be the first one ever written on that subject. Go for it, Says there have been some efforts to do it before to define what is anarcho-capitalism. And what I did is, and it's in book form now, the new libertarianism, anarcho-capitalism. But this was over 50 years ago. So I've had this view that ultimately the errors of statism, meaning the rise of the government and their institutions, particularly their central banks that monopolize the essential commodity of human interaction, money, okay? It's the basic commodity. And it's like they had a nationalizing of the price of wheat. How many acres are grown? What's its price? Well, you can imagine what disaster that would be. Remember the Soviet Union. Well, they do that with money, and yet we call it a free economy. And yet they have a monopoly control over the quantity and the pricing of the most essential commodity in human economics, okay? Ultimately, they create errors, boom-bust errors, that embed themselves in the economy, in real people's everyday life, individuals, corporations. And I think we're at that point now where they've done it in such a way over such a wide area of the world, not just the US, okay, that the public is fearful here and elsewhere. Example, Argentina. Argentina used to be the 7th largest economy in the world about 60, 70 years ago, okay? Now it's we treat it as a third world country. They've been under a two-party system for decades that are both socialist. The economy sucks. And the public there is just was fearful and just can't take it anymore type attitude. They didn't know the answer. They just knew, get rid of it. Javier Milei was elected president a year ago. He's an overt anarcho-capitalist. He is starting to dismantle government in layers. One of the results, for example, and this you talk about the economy, when this starts to happen in the U.S., when the market goes down, which creates sentiment. Then fear rises, and all kinds of things get thrown in the air. Notions that we accepted decade for decade, suddenly, this doesn't work. Get rid of it. There's already talk of abolishing the Fed. There's already talk of abolishing the IRS, okay, and go to other forms of taxes. These kind of things can happen dramatically, and they'll largely be a function of the fear element rising. And I think the fear element will largely be sparked by that one thing that makes people smile now. What's the one thing? Their retirement account. They look on the screen, oh, I was up 20-something% last year. Great. Everything else sucks, but my retirement account looks great, okay? You take that away from them, you suddenly give them a haircut of 20%, which is easily possible. I'm not talking crash, 35%. You take 10, 20% off that retirement account, and fear will start to come in to everyday life, in which case it's 52 card pickup. And all kinds of things can happen. Politically, notions can go out the door, or like in Argentina. A guy wasn't part of either mainstream party, destroyed them both. And now suddenly rental prices in Argentina have collapsed, meaning the people who couldn't afford rentals because of government control, rental control, all the rules and regs, kept prices so high, despite the government saying they'll keep them low. It was a shortage of housing for people who wanted the rent. Now suddenly there's a 20% collapse in that over the last couple of quarters because of what he did. He got rid of the entire government agency involved with controlling rentals. These kind of things can happen. And I think one of the sparks that will help that is the breakage of the stock market. That will also help fuel monetary metals because we know what the central banks will do.
Do you think we're close to that moment in the stock market?
I think we are. The S&P has already kicked itself in the shin a week or two ago by our metrics, meaning it's done enough initial damage via quarterly momentum, which is a fairly long-term metric, for us to say it's in trouble. The problem is we want that NASDAQ 100 to trip our numbers. And so far, it's avoided them. It's danced above and below the number that we've specified. Right now, it's back above it again. It was below it a couple days ago. We see a weekly close below that number, then we'll say, okay, now it's likely to start. Why NASDAQ 100? Because it's gone up more than double what the S&P has, and because that's where all the leadership is housed. The 7 great stocks. They constitute like 50% of the NASDAQ, quote, 100. 5 or 6 symbols do. So that's where we're focused. You break the mama market. And that's when the fear will start to come in because you'll start to get price decline. It'll alarm people. Money will then begin to flow out of that into other categories, and central banks will begin to panic.
Yeah, and that makes sense. And it would, in theory, bring down other markets along with it. Those markets like, the Russell 2000 or the Wilshire 5000 or even the Dow that are already in many respects, many of those stocks are treading water, being held up by the Mag 7. Michael, your insight is fantastic. It's always hard to think of a last question to ask the guest, one that encapsulates what we've already talked about, plus talking about the future. So forgive me for asking this question because you've kind of already answered it a little bit, but I guess before I let you go and ask you how people can find out more about what you're doing, if momentum analysis could speak, what would it tell us about where the world is heading? What would it tell us about where the markets are heading?
Well, as far as the world is heading, anytime there have been compounded errors over decades, I'm not just talking 4 years of Biden, I'm talking about decades of this sort of government further and further control over every aspect of your life and the economy, particularly the money control. When those errors get exposed and people throw their hands up in the air, you get dramatic changes. And I think it's about to happen. And I think the place to be, frankly, is primarily gold and gold related. Also commodities to some extent, I think they will be pursued. And I think it will lead to positive change because when sometimes, have a baby is painful, okay? Sometimes getting something good requires tearing something down that has not been good. And I'm not involved in politics anymore. I've written my thesis, and it's a book and so forth. But so I sit back and I watch events, and I focus on MSA's work. But I can see this unfolding, and I think we're literally in part 3 of Atlas Shrugged right now, where the S starts to happen, and it happens rapidly. And getting rid of things that are bad institutions and ideas is not a bad idea. You know, it'll happen naturally, not by some unified force winning an election or something. It'll be ground up, and it reveal itself in many different ways. And I think we're headed to that sort of crisis now. But crises can lead to good outcomes. You know?
Right. Yeah. Opportunity within every crisis.
And then, yes. And you want to be on the right side of those events as well. Yes.
Well, that's why people should be listening to what you have to say. And with that being said, how can people find out more about your work, which is fantastic? I highly endorse it. How can people find out a little bit more about what you're doing?
OliverMSA.com is our website. Take some time, tool around there. We discuss our methodology. There's a lot of our archived reports, particularly on S&P tops and bottoms. And request some samples. I'd be happy to send them to you. And anyway, we look at all 4 major asset categories, or just look at the stock market or gold market or so forth. You look at all the commodity categories, and, you know, as a category of the bond markets, foreign exchange, which has really been a dormant issue for the last couple of years, by the way, and of course the monetary metals. So, you know, and they interplay. So it's important to not just focus on gold if you're in gold, but to look at the things, the icebergs that are bumping into you, positively or negatively. And that's why we watch all the major categories.
How about the crypto markets?
Yes, we do a report on that too. And I do not think that Bitcoin is a salvation. I do not think it is competition to gold.
Nor do I.
If anything, it is an overlay right now, especially for the last several years, of the NASDAQ 100. They behave almost similarly, sometimes even day by day. So you can take that for what it's worth, but it indicates to us that if the NASDAQ 100 is a bubble, be surprised that crypto is a bubble.
Roger that. Well, that's a mic drop right there. Michael, I appreciate your time. Love to have you back on down the road. I wish you and your family, all you and yours, very happy, healthy, prosperous 2025. I'll be following your work. I hope others are now incentivized who are just finding out about you to do the same. And until we pick up again next time, thanks again for dropping in. I really do appreciate it.
Thank you much, Andy.
You're welcome.
Little by Little with Andy Schechtman.